Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our EIA show, and we're going to break it into our normal three parts. In the first segment, we're going to look at more along the global market, and then really looking at the EIA from a high level before we dig in a bit more on the data. And we want to look at how the Russian shifts or the sanctions are shifting crude. What does that mean for Russia? What does that mean for floating storage? And how is the U.S. responding? Now, in segment two, we're going to go much deeper into the demand side, into local, or I should say regional storage, because there continues to be this broad disconnect between Pad 1 and the rest of the country. And we really want to go through some of those key pieces, as we did on the FSC show, looking at Pad 3 versus Pad 1 on the distillate front. Then when we, in segment 3, we want to look at how global crude shifts are happening, more importantly on the distillate side, because diesel continues to be a bright spot, but distillate, there are some shifting flows. What does that mean? And we continue to see a big shift in gasoline from Europe into the U.S., and we really want to look at how is that driving diffs and then or differentials, and then what is happening to floating storage on the back end. So here, just kicking off the segment 1, here you can see the Russian seaborne crude. Now this is as of the 2 weeks ago, but things have been fairly stable in terms of flows. So now there's about 4.3 million barrels a day slated for export. But what can actually be tracked when you look at what we've pulled down from Bloomberg is about 3.435. So it's still a fairly sizable amount of volume, but you can see that there's been a much bigger increase into the Pacific. Now, there's a certain cap in terms of what's available, and we've had some charts beforehand. It's about 1.2 to 1.3 million, where you're really not getting above that, just given the limitations on pipeline capacity, the limitations on loading capacity. There is some flex in terms of what can go into the eastern part of Russia. Now, when we look at the Black Sea, the Baltics, you can see that they're going to try to do as much as they can into the Arctic and to the Baltics, as the Black Sea continues to have those different those problems in general. But right now we did get an increase. A lot of that is going into India, and we're going to talk more about where those flows are going and how much is going to continue to move going forward. So overall, crude shipments in general edged lower in the 7 days to May 20th, but showed little clear impact from the EU restrictions that came into effect on May 15th. And the reason why is because a lot of these barrels are just moving into other markets. And then those markets that typically buy from other places are shifting. So you're getting a shift in terms of West African, Middle Eastern crudes, and when you look at Asia, they're trying to purchase the discounted barrels as much as possible. So then when we start looking at the long-haul voyages remain a feature of the latest data. Not surprising, long-haul, aka more miles per ton, though the volume of crude making the journey to Asia fell from the previous week, because again, it's going to ebb and flow in terms of what can move into the market. 4 tankers that loaded crude at Russia's western ports in the week showed destinations in India, with another 2 heading for the Suez Canal and 2 more on their way to the Mediterranean from the Baltic. So again, that's going to continue to be a mainstay. The question is just based on availability of ships and then insurance. If the availability of ships, or the ships that face sanctions and don't want the risk, that's going to impede the amount of crude. But so far, this is what we continue to see. Now, just to break down the amount of Indian imports of Russian crude, you can see that there has been a huge surge on both the crude and the fuel oil side. Now, we don't see that changing. We see that being a continuous piece. And to be fair, given how bad, or how, and we went through this on, was it 2 weeks ago on the segment 5 on Indian inflation. Indian inflation is off the charts. Like, I mean, we're seeing it continue to push. They're trying to cut pricing. They're trying to cut tariffs. So they need the cheapest crude available, and that is going to keep them running Russian oil as long as physically possible. And then China is also boosting imports of Russian ESPO crude from the Far East, with some barrels possibly flowing into onshore storage. The question is, how much can they pull in, given that they still remain under some sort of lockdown? And then when you start looking at where the lockdowns are hitting, There's concern that Beijing is going to go into a lockdown. Some other places are starting to come out, and we're starting to see some of the increase in refinery run rates, which we're going to talk about in segment 3. But again, this is something to keep an eye on. 20 of the 21 oil cargoes that have been loaded in the port of Casmino so far this month are heading for China, which again is going to displace some of that West African crude, which is going to make it available, or I should say more available, for the European and U.S. markets. Now, when we start looking at some of the different shifts, bookings for May loading shipment of clean fuels from Asia to the Americas eased by 5,000 tons to 325,000 tons, still elevated and still an increase coming into our markets. Now, just thinking about tax cuts. India announced tax cuts on fuels and boosted its subsidies for crop nutrients to tackle mounting inflationary pressures, which again is going to support a lot of these additional runs. Seaborne crude flows edged lower, but again, you can still see they're holding closer to about that 3.5 million. When you look at the physical structures, there's a cap at about 4.3 million. And that's when you can see that we've gotten closer to that, but there's really a hard stop once you get to that level. But they're going to try to do as much as they can just to make sure that they continue to push it into the market. Russian seaborne crude exports from its western ports to Asian countries, predominantly obviously India and China, rebound to more than 1 million barrels a day and could rise when destinations are finalized. In the east, flows of the so-called grade have dried up, with sanctions starting to bite. But again, they're still trying to work around that. So that's where we're going to continue to see some of those different flows. And then when we start looking at gasoline movements, so as we've been talking about, the European markets have had a record amount of gasoline exports. And we had been talking about how we expected a big shift in terms of those exports coming into Pad 1, and the flotilla is on its way. So when you look at imports, flows to the U.S. coast from Europe will jump to about 487,000 barrels a day this month, the highest since May 2019. Europe's crude imports. But then, so when you think about gasoline is going to keep coming this way, you can see the big shift that's going to remain the case. And we should see that continue to show up at different levels, just because obviously there is a sailing time. But then in the reverse, the U.S. is sending a record amount of oil into the European markets. Europe's crude imports from the U.S. Gulf in May are set to jump to about 1.36 million barrels a day, the highest level in at least 3 years, which again is just because Europe is trying to shift away from Russia and find these different flows. And in segment 3, we're going to have a reason why, and a key reason why Germany is going to be or remain one of the biggest buyers. So now when we start looking at total oil products and oil end products, we want to look at some of the different shifts, because when you look at total oil end products, you had a little bit of a reduction. We went from a deficit of 102.5 to a deficit of 114.5. Total crude, looking at land and floating storage, went from 34.6 to 38.8 deficit. But the product one is the one that we want to talk about for a minute, because the deficit widened from 67.9 to 75.8. And some of the key reasons for that is when you look at the shifts, because when you look at Asia, Singapore, things were fairly flat. Fujairah had a build, but we had a draw in Europe, and a lot of that is in transit right now. So yes, it's not in stockpiles, but a lot of that is now in transit on the water, and then will come into storage on the U.S. side. So this is where we're going to have a bit of a timing delay in terms of where things are. And then when you look at land and floating storage on the crude side, we're still within the 3-year range, and a lot of that remains on the water, not in land storage. And there's a lot of reasons behind that outside of just cost, because when you look at West Africa trying to increase some prices, we've had a huge surge in floating storage on the West African side. Middle East remains elevated. And again, that's just a matter of, well, they're waiting for prices to come down, or buyers are waiting for prices to come down. And there's just kind of this Texas dual, stalemate in terms of just looking at each other, saying, okay, well, who's going to blink first? And this is where, when you look at storage, and we'll go down based on the different two, but the product side continues to be robust on the diesel front. The distillate front, where we continue to remain at either at or near all-time lows on the global front, and we'll break that down in segment 3. But gasoline is going to be a bit of a timing delay between exiting European storage and then coming into U.S. storage. So West Africa's oil exports to Asia are set to gain this month as shipments to China recover some ground from April's slump, but it's increasing, but it's coming off of a fairly low base, and there's not a huge shift. And 55 cargoes of crude are due to load for Asia in May, equating to about 1.69 million barrels a day, gains from the revised 1.63 million barrels a day in April. So again, still much lower, and the pressure is really because of those cheaper Russian barrels. Now, when we go on land, here you can see that there is the deficit widened from 76.9 to 92.3, and a huge driver of that was when you start looking at the west of Suez. So when you look at west of Suez, you had the U.S. and ARA. The deficit went from 59.4 to 70.5, and a lot of that was driven by not only just the U.S. but also Europe. Now, Europe has reversed all of that drop. So again, it's just going to be that timing delay in terms of, okay, well, what's offshore? When is it going to come onshore? What are refiners doing? And right now you're going to see that reverse. It's still going to be in a deficit. I'm not saying that we're going to close the gap to the average, but some of that is going to reverse. Now, east of Suez, you had a drop from 24.6 to 30.5. That again is a decent amount of timing delay, and we do see that reversing, but still in a fairly bright spot when you look at it against the seasonal average. The thing that we've been talking about is we expect this to stay fairly flat through the summer, and that's when you see that typically you kind of get this increase. You're building storage, and then you start to draw down, and then you come to this low end. So that's when we start looking at the comps. The comps do get easier as we progress through the remainder of the year. Now, when we start looking at floating storage, the surplus narrowed from 43.9 to 23.2. That's something that it dropped, and now it's going to reverse. And it's all coming down to just where is the floating storage and how long is it in transit. So the longer it's in transit, the more that will show up in oil in transit versus oil in floating storage. And then it goes from transit, from floating in one, transit back to floating in the other. And now those are some of the key pieces that we're going to continue to look at. Now we flip to a deficit in west of Suez from a surplus of 0.4 to a deficit of 2.2. That's going to reverse, based on where we are on the West African front, and that's going to see another surplus. And then when we look at east of Suez, when you look at Asia, Middle East, the surplus narrowed from 40.8 to 25.1. Now that's going to remain a bit reduced because it's going to be a matter of timing from when does that Russian crude show up in the Asian shore. And as some of these places in China start to get back to normal, and normal is a relative term, from the COVID lockdowns, that'll again transition from floating storage to onshore storage. So now when we look at crude in the U.S., we had a draw of 1.02 million. It was driven by Pad 2, which had a drop of 1.34 million, and Cushing a drop of 1.06, while the Pad 1, Pad 3, and Pad 4 had some small builds, with Pad 5 having a small drop of 520,000 barrels. So when you look at the different backdrops, Pad 4, Pad 5, and Pad 1 remain in fairly stable versus the 5-year. Pad 2 still 36.9 million below the 5-year, Cushing 25.9, and Pad 3 22.8 below the 5-year, with a large part of Pad 3 being the exports that continue to go into the European markets. So that nets out to a drop of 94.8 million in the 5-year average, and we'll have charts on the different backdrops. Then when you look at including the SPR, there was a drop of 6.99 million, as some of that goes from the SPR into the commercial markets, and again, that's also going into the export market, which is providing some of that support as well. It's just right now we're putting more sour grades into the market, where we really should be putting more light sweet into the market. But again, it is what it is at this point, and I've tried to explain why, but nobody wants to listen. So if you want to hear me rant on it, you know where to find me. Crude oil production, as we said, bounced. We see it starting to creep just above 11.9 now. We're at about an 11.93 on our way to about 11.95, and we should be to about 12 million as we get into the very end of June, and then again that sets us up for what we've been saying as a exit rate of about 12.2 million for the year. Now, when we look at runs, as we were saying, we expected to see a nice bump, and this was before I had to travel for work. So last week we got the bump from about 90 to 91.8. Now we had another increase to 93.2. This could dip a bit just because we did have an unplanned downtime, which will shave off some of pad 3. But again, we're still going to remain fairly elevated just given for this time of year. We will continue to move up closer to about 95% utilization rate, but again, that is going to take a bit of time. So here you can see, and as we've been saying, pad 3 continues to be where a lot of that production, the refinery utilization rate comes back. And as they come back, we should also see those increases in imports in order to create and try to target that distillate cut. So then when you look at the different backdrops, we're well above the 29-year average. But again, we're still moving closer to where we should be for this time of year. And when you consider where we are versus the 5-year average, we're about 7% higher. But there's a lot of reasons why we should be, just given the distillate cut and the amount of money that can be made in that crack. So you can see that on the 29-year average, we normally have those increases. Obviously, it's going to be a little sloppy depending on the day or the week. So that's when you start to smooth it out. You can see that we're still moving in a fairly comfortable fashion versus the previous 29 years. Now, imports here, you can see that there was a small drop of by 80,000 barrels. That's 514,000 a day below normal. And a lot of that, and most of it, was driven by pad 3, which had a drop of 291,000 barrels a day. A lot of that being timing, because we did get a big surge in exports. And because of how tight some of the waterways are, some of this is one-way traffic only. So if you have a lot of exports, you don't have as many imports. And typically you have that reverse, where pad 5 continues to be lumpy, but we did get an increase of 369,000 barrels a day, remaining well above the 5-year average. So when you start looking at the imports into pad 3, as we've been saying, we expect to have higher highs, higher lows, and move much closer, not so much to the 5-year average looking at this chart, but much closer to that middle ground where you're going to be well off of the bottom end of the cloud, but again, not quite to the 5-year as things continue to progress a bit further. Especially when you start talking about the Shell has completed U.S. Gulf Mars oil platform maintenance. So again, we should see a bit more of that coming through, and we will get a little bit more maintenance that's still coming through, but it should finish by early June. So again, you're going to get a little bit more coming through, and that'll show up with just a bit more of the heavier sour coming into the U.S. being able to be operated and run. Pad 2, as we've been saying, is going to remain well above the 5-year average, staying closer to the top end of the cloud, and we see that persisting, again, just because we need the heavier crudes, especially for the distillate cut. So the implied demand here, you can see that gasoline had a drop of 229,000 barrels a day. This is where we should get a big bump as we go into the end of this week and into next week because of Memorial Day weekend. Memorial Day weekend is usually where we kick off the summer driving season. So you normally have a little bit of a push to make sure that the gasoline is available. Then you have a little bit of a lull as we come through the prior week, and then you get that big bump, and then you typically get a little bit of a slowdown, and we'll show that in a chart form just to kind of see where we have seen it normally. Distillate remaining fairly stable, a small increase of 51,000 barrels a day. As we've been saying, we expect to kind of hold within this line. Let's call it between 3.7 and 3.4 million barrels a day, just because the trucking is starting to flatline. Not going to see a huge surge, but something fairly stable. Jet, again, you're going to remain between that 1.45 to 1.55, well within that range. It'll start to shift up, especially as we get closer to the end of school, increase of vacations, but we'll talk about that in a minute. Residual fuel, again, is just going to ebb and flow a bit. So there was a nice pop here, but that will fade as some of that normally does. And then propylene, drop of 428,000 barrels a day. That again will increase, but it'll still remain fairly strong, especially into the export world. Now, when we start looking at gasoline implied demand, here you can see that we're well off of where we are or have been outside of 2020, and we continue to stay fairly stable and sideways. And that's what we believe is going to happen, because in the US, you don't get demand destruction the same way. You just don't get that huge surge up, but we will get some bounce. And you saw it in 2021. You've seen it in 2020 and 2019, where you get that bump ahead of Memorial Day. Then you maintain it, then you get the steep drop off, and then you start to settle at a higher high as you go into summer driving season. We expect the same thing to happen, just at a percentage step down. Whether you want to call that 5 to 10%, it's just going to be a little less than where we were, and most of that is going to be driven by pricing at this point in time. Now, when we start looking at crude oil inventory, excluding SPR, fairly flat, and as we've been saying, we expect it to just go sideways as those imports try to offset, especially as we get an increase in refinery run rates. Now, the supply of crude continues to be fairly flat. This will drop again just because we did get a drop in crude in storage and we got an increase in refinery run rates, but still holding very close to the 2018 levels. Now, when we start looking at commercial oil storage end products, you can see that steady kind of grind down, with a lot of that being driven by the product side, and a lot of it being the distillate and gasoline front. Now, gasoline's going to start to reverse. That'll take time because, again, it's just a matter of when the imports show up and demand doesn't quite get to where it was, and then distillate continues to have those steady builds. But remember, distillate is supposed to build this time of year. So the rate of change is going to be very important to see, okay, well, are we making up ground, or are we just seeing the normal increase in builds? But again, we need to see that accelerate. Otherwise, we're going to be in a very interesting spot as we go into the heating season. So now when you look at gasoline storage, one of the things that we were expecting was, let's call it starting about 2 weeks ago, was to see some of this flatline. And the reason why we thought it was going to flatline, or I thought it was going to flatline, was I was expecting imports to start sooner. And now it started. There's a huge flotilla coming. But again, I was expecting this to start about 4 weeks ago, starting to show up, let's call it, 1.5 to 2 weeks ago, and then continuing to be fairly stable. Something similar to what we had in 2021, where you had a nice drop, and then kind of went flatline. Instead, we've continued to curl down. And a lot of that has been twofold. One, slow down on imports, just haven't really started yet, or haven't started to show up yet, but they will, as we showed earlier. The other one is an increase in exports into Mexico, which has been keeping storage moving down. But again, we do expect this to reverse a bit higher. Now, when we start looking at distillate, again, you can see that we're building, but when you look at the lines that we're going against, we're supposed to build right now. So if you look at just the rate of change, it's fairly stable. Like, we're not getting this bigger increase. So we're just following the normal trend. But given where we are, we need to see that accelerate a bit. Now, the crack supports it. We will see that. It's just the question is how much of it is going to go into the international market, because the diesel market remains very robust, globally speaking. And this will mirror or mimic some of those different advantages. Kerosene, jet fuel continues to move back up. Here you can see we're at the highest level we've been in 2022, and this is a lot of it is a prelude to the push for and the increase in flying for the summer vacation season. So nothing too crazy or abnormal in what typically happens this point of the year. Here you can see that we're back above $100 a barrel, essentially to the end of the year. Then when you go, we're above 90 through June of next year, and then above 80 through essentially July of 24. When the biggest shock to me was not so much the front month but was the drop in the back end of the curve. So when you look at that blue line there, that's a month ago. So a month ago, you had this huge shift. Even when you look at the front month, we were still over 100, but you had this big drop in the back end of the curve, and that was where we were saying that's the opportunity. Like, we shouldn't have had this huge shift down. And now you can see that obviously the front month has come up, but there's been a big pivot in that middle of the curve and really all along the curve as it has shifted to the right. And that's something that we think that there remains opportunity in terms of the belly of the curve and even the front end when you look at, and again, December is an important month because December typically has the most volume out of any month when you look throughout the whole curve. So typically it's December and June. So that's usually where you want to target when you're looking at something a bit deeper in the curve, because obviously volume is much less, but that's where it's a good place to target in terms of trying to get some volume. Spreads aren't as wide, and you can try to get some exposure. Again, wouldn't go crazy just because if there is a big move, that's where you could lose some volume, but that it remains some opportunity. COVID, for the most part, just continues to remain fairly stable. We don't see this really impacting all that much. Asia Pacific is flatlined. As you can see, Europe, UK, US, again, small bump in the US. But it's a little tough now, especially when you look at what is happening in the world today, because we've, at least speaking locally from my perspective, we've had a lot of friends around us get COVID, but everyone has rapid tests, so you test at home and you're not going, so you're not really getting filed. But again, it's essentially a bad cold at this point, given what we've seen at this juncture. So not a huge shift in terms of where things are. And then when you look at Asia Pacific, things are fairly stable. The biggest issue is mainland China. So things have gotten better, but now there's some continuous surges in Beijing, which is renewing some fears around lockdowns. Now, when you look at inventory in pad 3, you can see that things remain elevated versus for 2022. We're at the high end. We expect this to remain fairly stable as refiners pull in more imports to create more distillate, and that offsets some of the exports that we're going to continue to see in that region. We've had a steady drop in Cushing. You can see that seasonally speaking, we normally start to get a bit of a drawdown. This is going through 2021. When you look at 2020, you've had some of that moves when you look at 2018. So again, we get some of these drawdowns, but we do expect to see a net increase over the next few weeks as we progress through the months. And then when you look at floating storage dropped back down, seasonally adjusted 5-year low. But again, this is going to be timing delays as to when does it move through. So we expect this to remain fairly low just because refiners are just going to wave it in because they're going to try to time the flows, and there's more than enough storage capacity. So why pay for floating storage if you have onshore storage? Because onshore storage is always going to be cheaper. And these are some of those key dynamics. So now in the next segment, we're going to go deeper into the refining space and the distillate space specifically, and we'll provide some color around where demand is and where do we think it's going over the next few weeks.